Okay. I want to start today with a question that, well, it sounds deceptively simple. In fact, it might even sound a little insulting to any finance professionals listening in.
Oh, lay it on me.
How do you calculate your total sales for the year?
Yeah, it sounds like a trick question, doesn't it? Like asking a chef how to boil water.
Exactly.
Yeah.
Because my instinct, and I think the instinct of most business owners, and honestly, even a lot of accountants, is pretty standard. You open your accounting software, you navigate to the sales register, you hit that really satisfying export to Excel button, and you just look at the bottom line.
Sum of all invoices equals total sales.
Yeah,
Done.
right. Next question. But we are doing a deep dive today into the sources behind turbo data sales logic, and according to this documentation, that instinct is actually a massive compliance trap.
It is. And that right there is exactly where the trap snaps shut. It's the fundamental difference between what we call screen truth and ledger truth.
Screen truth versus ledger truth. Okay, define that for us.
So what you see on a dashboard or a formatted sales register is screen truth. It's designed for the user interface. It's for convenience, for, looking at a list of papers, essentially.
Right.
But what the law actually taxes, what the Income Tax Department and the GST Council genuinely care about, is ledger truth. And I have some bad news for you. They are rarely the exact same number.
Wait, so relying on the sales register, the very tool the software gives me explicitly to track my sales, is actually dangerous.
Potentially fatal for your compliance. Today, we're unpacking a stack of technical documentation, logic flows, and specific Indian tax acts to understand why this specific data architecture uses a ledger-centric approach rather than a voucher-centric one.
And honestly, looking at these notes, this isn't just about database code or SQL queries.
Hmm.
This is about whether you survive a Section 73 notice or a tax audit without just bleeding cash.
Precisely. The mission for today's deep dive is to figure out why invoices issued does not equal actual revenue in the eyes of the law. We really need to shatter the illusion that the sales voucher is the only thing that matters.
I love how you went straight to survival there, but it makes sense. So let's start with the definitions, because the source material gets technical very quickly. When we talk about turbo data sales logic, what are we actually counting? If it's not just the sales voucher, what is it?
So in this architecture, sales is defined by a formula, not a document type. It calculates the sum of all postings to any ledger that is classified under the sales accounts group.
All postings. That sounds significantly broader than just a list of bills.
It is, and intentionally so. It doesn't care where the number came from. It pulls from sales vouchers, naturally, but it also pulls from journal vouchers, credit notes, and debit notes. If it hits the sales ledger, it counts.
Okay, that's a real paradigm shift. Usually people think, well, if I sold it, I made an invoice for it. But you're saying revenue can move through other channels entirely.
Absolutely. Think about your accounting software. At its core, it's essentially just a database. A sales register report is usually a pre-filtered query. It asks the database, hey, show me all transactions tagged as a sales voucher.
And it just ignores everything else.
Exactly, it ignores the rest. But a ledger query asks a much better question. It asks, show me every single time the balance of this specific account changed.
And that captures the reality of the money, not just the paperwork.
Precisely. Now, the logic does put in some very specific technical filters, data hygiene, really. The documentation notes that it specifically excludes entries where is canceled is yes, is optional is yes, and is deleted is yes.
I can guess canceled and deleted, but what exactly is us optional?
In many ERP systems, ICE optional refers to draft vouchers or pro forma scenarios.
Ah, okay.
Yeah, you create the entry to see how it looks or to send a quote, but it hasn't been finalized in the books yet. You clearly don't want to pay tax on a draft invoice that was never actually issued to the customer.
We certainly hope not. But there was another term in the logic that caught my eye. Sign correct logic. Can you unpack that a bit?
This is crucial for getting the math right. In accounting, as you know, revenue is a credit balance. So the turbo data system looks at the ledger. If there's a credit entry, it interprets that as increasing revenue. If there's a debit entry, it interprets that as decreasing revenue.
So it automates the math regardless of the voucher type used to create the entry.
Right.
So if I have a sales return, that's a debit to my sales ledger.
Correct. And the system automatically subtracts it. But here is the real aha moment for most people. A manual export of the sales register usually only lists, well, sales vouchers.
Right.
It often completely misses the journal entries that adjust revenue because they simply aren't tagged as sales vouchers.
That is a massive gap. If I pass a journal entry to correct a pricing mistake, My sales register might not show it, but my ledger definitely feels it.
And Indian tax law does not recognize a sales voucher as the ultimate truth. It recognizes books of account.
Meaning the ledger balances.
Exactly. If you are reporting based on the register and your ledger says something else, strictly speaking, you are misreporting.
Man, that feels like walking through a minefield blindfolded. You think you're perfectly safe because the Excel report looks clean?
And the first mine you step on is usually GST.
Right. Let's talk about the monthly headache. GSTR1 and GSTR3B. I feel like this is where the panic sets in for most finance teams because the frequency is just so high.
It should be a major concern. If you are only using the standard sales register for your GSTR1, you are missing critical adjustments. Let's look at the legal context here. Section 31 of the GST Act covers invoices,
Okay.
but Section 34 covers credit and debit notes.
So the law clearly acknowledges these adjustments exist outside the standard invoice?
Exactly. And Section 37 is about furnishing details of outward supplies. Now imagine a real-world scenario. You issued an invoice for 100 rupees, but there was a pricing error or maybe a post-sale adjustment, so you issued a debit note for another 10 rupees a few weeks later.
So my total sales, my actual tax liability should be 110.
Exactly. But sometimes, especially in fast-moving operations, people pass that debit note through a journal entry, or they classify it in a way that doesn't show up in the standard sales register report because it's not strictly a sales voucher type.
Or even simpler, the ERP's default sales report just doesn't include the debit note voucher type by default.
Very common. So what happens? You report 100 to the government on your GSTR1.
But my ledger, my books of account shows 110. Now I've underreported my liability.
And here come the notice.
Section 73 or 74 notices for short payment of tax.
Right. And it's not just paying the 10 rupees you missed. It's interest at 18%. It's a penalty on top of that. All because your data extraction logic was voucher-centric instead of ledger-centric.
And I assume it works the other way too. If I miss a credit note or a sales return because it was processed via a journal.
Then you've overreported. You paid tax on money you didn't even earn. You've blocked your own working capital. And anyone who has tried to get a GST refund from the department knows, well, let's just say it's not a quick afternoon task.
Yeah, getting money back is always harder than getting it right the first time.
That's where the sign-correct logic really saves you. The system doesn't care how you reduce the sales, just that you reduced it.
Yes. If the turbo data logic sees a debit entry in the sales account, maybe a return, maybe a discount adjustment, and it automatically reduces the revenue figure. It acts as a safety net.
It captures the financial reality, not just the data entry method.
It really emphasizes that the method of extraction matters just as much as the data entry itself. You can have the best accountant in the world entering data, but if the report query is wrong, you're still completely non-compliant.
It's actually more critical than the data entry in some ways. You can enter data perfectly, but if your extraction query asks the wrong question, like show me all sales vouchers, you get the wrong answer. You have to show me everything that touched my revenue ledger.
Okay, so that's the monthly grind of GST. But then we get to the end of the year. Income tax returns and the tax audit. Form 3CD, this is where the external auditors get involved.
The big one. This is where things move from an administrative error to a statutory violation.
Does the logic really change that much from GST to income tax? I mean, revenue is revenue, right?
Ideally, yes. But the stakes and the strict legal definitions shift. In income tax, specifically under Section 145 of the Income Tax Act, you are mandated to follow the mercantile or accrual system of accounting.
Let's do a quick refresher for the listeners on that. Accrual meaning I record income when it's earned, not just when the cash hits the bank or when the invoice is printed.
Right. Or, more importantly, when the right to receive that income arises. This is the classic March versus April problem.
Oh, I know this one.
Often, at year-end, companies pass journal entries to recognize revenue for work done in March. Even if the formal invoice doesn't actually go out until April, they have to do this to match the expenses they incurred in March.
I see. These are the provisional entries.
Exactly. Now, by definition, these are almost always journal entries. They are never in your sales register because the invoice hasn't been created yet.
Oh, wow. So if I just export my sales register for the year to give to my tax consultant for my ITR, I am 100% missing these March accruals.
And by doing so, you are violating Section 145. You're technically concealing income for that financial year.
Concealing income. That phrase alone makes my palms sweat.
As it should. Under Section 270A, misreporting or underreporting isn't treated as a casual, oops, my Excel formula was wrong. It can be penalized as concealment of income, which carries heavy penalties. We're talking ranging from 50% to 200% of the tax payable.
That's brutal. So TurboData's logic effectively protects you from accidentally breaking the law just because you used the wrong report.
Precisely. It looks at the books. If you passed a journal entry to accrue income, the ledger-centric logic picks it up and adds it to your turnover. It ensures your income tax turnover matches your actual books of accounts.
And this feeds directly into the tax audit report too, right? Form 3CD. I know the sources mentioned some very specific clauses that get impacted.
Heavily impacted. Look at Clause 8, which asks about your method of accounting. If you claim to be following the mercantile system, but your sales logic misses the accruals we just talked about, you're basically lying on Clause 8.
Yikes.
Then there's Clause 12, which deals with ICDS income computation and disclosure standards. Clause 12 specifically looks at revenue recognition. If your extraction logic misses those year-end journals, your auditor might sign off on a report that actually contradicts your own ledgers.
That is a nightmare scenario. You're basically handing the tax officer a glaring discrepancy on a silver platter.
It gets stickier, too. Let's talk about Clause 34.
Clause 34. Wait, that's TDS compliance, isn't it? Tax deducted at source.
It is. And this is where the hidden danger of journal entries really bites people.
I'm struggling to see the connection here, honestly. I thought TDS was mostly for expenses. I deduct TDS when I pay a contractor or a consultant. How does my sales logic affect TDS?
Think about revenue reclassification or netting off. This happens all the time in distribution businesses or marketplaces.
Okay, walk me through a practical example.
Let's say you are a distributor for a large FMCG company. You sell goods worth 1 lakh, but the company gives you a 10,000 rupee commission or a performance discount. Sometimes, instead of receiving a separate check for that commission, you just pay them 90,000 against the 1 lakh invoice.
Right, netting it off. Standard practice to save bank charges and administrative hassle.
Very standard practice. But how do you record it in your books? You might pass a journal entry debiting the supplier to clear their balance and crediting your commission income or sales ledger.
Okay, so I formally recognize the income in my ledger.
You have, but if your sales report misses that journal entry because it only looks at invoices, 2 things happen. 1, your turnover is understated, which we already discussed. But 2, and this is the real trap, you might forget to check if TDS was applicable on that commission entirely.
Oh, because Section 194H applies to commission income.
Correct. And Section 194C for contracts. If you book that 10,000 rupees as income via a journal adjustment, but you don't deduct TDS on the gross amount involved in the transaction, or if there's a cross-charge involved, you run straight into Section 40.
Which is the disallowance section.
Exactly. The income tax department looks at it and says, you didn't deduct TDS. Fine. We won't let you claim the associated expense. Or, in the case of netting off, they might view that 10,000 as income you actively tried to hide because it wasn't on your main sales report.
So the TurboData logic, by surfacing that journal entry as part of your sales or revenue, essentially forces you to acknowledge it.
It puts it right there in the turnover figure. You can't miss it. It forces the reconciliation. It creates a safety net where your finance team can say, hey, we have a journal entry here increasing revenue. Did we handle the compliance for it? Did we check the TDS implications?
It effectively turns a technical, boring data point into an active compliance trigger.
Exactly. It connects the dots between Clause 34 for TDS and your overall gross turnover.
It seems like the common theme here is that voucher-centric logic is superficial. It's looking at the surface, the piece of paper, the printed invoice. But ledger-centric logic is looking at the actual financial reality of the business.
That's a great way to put it. And that brings us to the ultimate goal here. Audit defensibility.
Right. The scary meeting. When the assessment officer, the AO, calls you in for scrutiny under Section 143.2.
When that happens, the AO does not ask to see your sales dashboard from your ERP. They don't care about your pretty pie charts or your formatted Excel exports.
What do they ask for?
They ask for the raw data. They ask for the ledger, the journal, the trial balance. They work from the bottom up. They want to see the bedrock of your accounting.
So if your reports, the very reports you filed your GST and income tax returns based on, don't match the trial balance,
you have a massive credibility problem immediately. You look incompetent, or worse, evasive. TurboData's approach is designed to be audit defensible from day one because it mirrors exactly what the AO is looking at. It matches the books of accounts perfectly.
There was a mention in the sources about automation, specifically Python and SQL playing a role here. It's not just about the philosophy of the logic, it's about execution.
Yes. The documentation mentions using Python to extract and normalize this data. Think about the alternative. When you export to Excel manually every month, you are prone to human error. You might skip a row, mess up a VLOOKUP formula, hide a column, and forget to unhide it before summing.
We've all been there.
The SQL logic defined in the source specifically handles things systemically, including what they call snapshotting.
Snapshotting, like taking a picture of the data at a certain time.
Exactly. It means capturing the exact state of the data at a specific point in time. Because, let's be honest, ledgers change. People backdate entries.
Oh, guilty as charged on that one. Let me just fix this entry from last month. Nobody will know.
Exactly. And if you do that after filing your GST return, you instantly have a reconciliation problem. The turbo data logic allows for maintaining snapshots so you can confidently say, this is exactly what the ledger looked like on the 10th when we filed GSTR1 versus this is what it looks like now.
That is crucial for answering audit queries 3 years down the line when nobody remembers what happened.
It's like having a time machine for your financial data. No, Mr. Officer, on that specific date, the ledger looked like this.
It reconciles ledger turnover versus GST turnover automatically. It just completely removes that I forgot to include the debit notes excuse.
It does. It removes the human error from the compliance equation.
So bringing this all together, we are living in a world of high-speed digital compliance. The government, frankly, has more data on us than ever before.
That's the big brother aspect we really need to mention here, the Annual Information Statement, the AIS, and Form 26AS.
Right. For anyone not familiar, these are the automated reports the government generates about us.
And where do they get that data? They don't guess. They get it from your customers, your vendors, your TDS filings, your GST filings. All of these government systems are interlinked now.
So if I report one turnover in GSTR1 based on my sales register, and a slightly different turnover in my ITR based on my audited financials, and then a third number magically appears my 26AS.
You get an automated notice. No human even has to look at your file to flag it. The computer just sees the mismatch and sends the email.
That is terrifyingly efficient.
It is. If your GST turnover, your income tax turnover, and your 26AS don't match, you are in trouble. And usually, the root cause isn't fraud, it's just bad sales logic. It's usually because you missed those journal entries or adjustments in one of the reports, but not the others.
So using a ledger-centric approach isn't just about being a nerd about data structures or database purity, it's about keeping the automated notices away.
Ledger-centric logic equals compliance. Voucher-centric logic equals exposure. It is really that simple.
It's a legal choice disguised as a technical one.
Perfectly said.
Okay, so here is the thought I want to leave you, our listeners, with today. And it's a bit of a provocative one based on everything we've just covered.
Let's hear it.
Next time you're at your desk, open your current sales report. It probably looks clean. It probably perfectly matches your printed invoices. But then go look at your actual sales ledger. Is there a journal entry sitting there that isn't on your report? If there is, ask yourself, are you reporting your actual income to the government? Or are you just reporting your invoices? Because as we've learned today, the tax department knows the difference. Do you?
That is the million-dollar question, literally in some cases.
Thanks for diving deep with us today. Check your ledgers, folks.
Stay compliant.